Hi, Heather. Hi, Beth. Good morning. Jamie's coming on in. Hi, Beth. How are you?
Good. How are you?
I'm awesome. Awesome. I
Good
love
to
all
be
this
here.
time with you guys. So fun. All my favorite ladies. Hi, Cindy.
Good morning.
Jamie. Okay, well, we have Karen here. I am going to introduce her and then just let her go. So I am super excited about Karen. We met in a group. When did you do that training? 2 or 3 months ago?
I think so. It was in 2020, maybe January. I don't even remember.
Yeah, exactly. But oh my gosh, I just love her. You guys are going to too. And she actually makes learning about this fun. So it's going to be amazing. And I mean, as easy as it can be. So just gonna find. All right. So Karen, this is Karen Kirkpatrick. Thank you so much for being here. She is a CPA, an accounting systems expert. She also is very familiar with and uses Profit First, which is what I teach my clients to do. Love this system. So she has been working with new and aspiring business owners for over 7 years, helping them get a handle on their business finances and taxes. So important. She's a coffee lover. Karen, I have a daughter that works at Starbucks. It's a problem. And a head for numbers, as well as a certified personal trainer and a mom of twins. So thank you again for being here. Such a pleasure. You're just such a wonderful person, and we're excited to learn from you.
Thank you so much for having me. I'm excited to be here. Not everybody likes taxes and numbers, but I do.
Yeah.
So I try to make it less painful for business owners, especially business owners that, as a business owner, your passion is what you provide to clients, your service, your thing that you provide, not necessarily the ins and outs of taxes and your numbers and things like that. But it's just as important because you have to pay the taxes. We can't get out of it, and you want to make sure that your business is profitable. Yes, we all come from a place where we just, I'm the same way. I love what I do, so I would do it for free, and that's how you know you're in the right field, because you would do it for free. But at the same time, you want to make some money, or you want to support yourself. And one of the downsides to having a successful business is that you have to pay taxes. So yes, taxes are painful, but that's how you know your business is successful, when you get a bill from the IRS. So it's not all bad. And when you have to pay your taxes, you're contributing money to the pot, and hopefully in the future we get to have some of those benefits, but we don't know. But it is what it is. When it comes to business finances, most people can get overwhelmed because it's not in their wheelhouse. So some of the tips that I have for tracking your finances is to keep it simple. If your income streams and your expenses are just, if you only have one stream of income and all of your expenses go through one bank account, you don't need anything fancy or complicated to track your finances. You can use a Google Sheet, your income and your expenses, and that's all you need. You do not have to have a QuickBooks desktop. You don't have to have a fancy software. If your model of your business is simple, that it's a group coaching or it's one-on-one coaching, if it's one product or two products, if it's simple and easy for you to do, keep it simple. Because if it's too complicated, you're not going to spend the time to do it's going to be overwhelming, and you're just not going to do it. And you're just like, I don't want to do it. So the simpler you keep the process for tracking your income and expenses, the more likely you are to keep up with it. It doesn't have to be complicated. It doesn't have to be detailed. It doesn't have to be too detailed. If you have a business bank account, which I highly recommend everybody does, if you don't already have one, definitely get at least one business bank account. The Profit First method does recommend multiple business accounts, but if you're starting where this is a newer thing, keep your personal and business finances separate. That's one of the first steps you try to do as soon as you can, is keep your personal finances separate. It will make everything cleaner. And there are some rules about it. It's not the end all be all if you can't do it, but there's definitely something. Is there a difference between a business? No, you can just have a separate account. It does not have to be a business account, as long as it can be with your personal bank account, but it's just one that you use exclusively for business. You can absolutely do that. Just have all of your inflows and outflows, try to keep them together. The other thing too, you can have a business credit card. It can be a personal credit card that you earn like rewards on, and that can, but if you are somebody who can use a credit card, some people can't because it signals trouble. If you can use a credit card, you can absolutely use a credit card that gives you rewards and you can earn cash back and things like that for your business purchases. Some people, in their personal life, like they put everything on a credit card and they pay it off every week and they earn the rewards and the cash backs and things like that. You can do that with a business as well. You can get a credit card. It doesn't have to be a business credit card, but a separate credit card where you can earn cash back. You can earn rewards. You can earn all of those things. That is totally allowable for a business. If you are in the position where you can put everything on the credit card and pay it off every week or every month, do that and earn the cash back or things like that. So you can absolutely use that approach as well. I had provided Kari with that fantastic little cheat sheet of all kinds of business expenses. So this is where I get the most questions, like, well, what can I deduct? So a business expense is anything that you use to help you run your business, grow your business, make you better at your business. Okay, so softwares and services like subscriptions that you buy online, your Canva subscription, your Zoom subscription, all those things that you are using to run your business, those are deductible. Things that you use in your business would be if you have a service that you provide. Some service providers, we have tools that we subscribe to that are more for, well, for example, mine, like I have QuickBooks and I pay for QuickBooks for my clients. So if there's things that you use like that, you can deduct those as well. Things that make you a better business owner, personal development books. Okay. If you go through your Amazon cart or purchases and see what maybe you paid for on your personal, because you have one account linked up to your Amazon. You just kind of buy stuff, you see it. If you have personal development books that you bought on Amazon, those are business expenses. They are making you a better business owner. They're making you better at what you do. Investments that you make into becoming a better a coach, even just a better woman, things like that. It kind of all transcends you as a person. So those are all generally business expenses as well. I could go, there's a laundry list of things for business expenses, but some of the most common ones are definitely look through your Amazon cart, because I bet you there's probably things that you paid for personally that you can take credit for. Your cell phone. So cell phone is one of those things that we pay for. You have a cell phone plan. You probably have it with your husband, your wife, your boyfriend, girlfriend. You might have multiple people on your plan. It's not necessarily something that you're running through your business. You're not paying for that out of your business account. But if you're using it for your business, whether it's to schedule calls, whether it's to post on social media, whether it's to network with people, whether it's just to take notes while you're, in the carpool line and you're using it to engage, things like that, your cell phone bill is deductible. I tell people to recommend approximately how much you're using your cell phone bill for business. If it's a 50-50 split, take 50% of your cell phone bill and make that a business expense. I could talk a little bit more about how we make it a business expense, because I'm telling you, like, okay, well, they are business expenses. Well, what does that mean? But we'll get to that a little bit. So cell phone bill is definitely one. Home internet. Right now, if you are working from home and you're a W-2 employee, you don't get to take home internet. But if you're working from home and you own your own business, your home internet is a business expense. There is, for most business owners, I'm assuming many of you out here are Schedule C business owners, which means your business and you are combined as one. The IRS sees you as one entity. Some of you may be separate, where your business is one entity and you are another entity. For most of you that are all one entity, your business and you file one return together. You have your 1040, which is your normal income tax return. And then you have this attachment called your Schedule C, which is where you report all of your business income and expenses. On that, you get a home office deduction. So you get to take a portion of expenses related to the maintenance of your house. So your mortgage interest, if you have an apartment, your rent, any homeowners association dues, homeowners insurance, your internet, your heating bill, your electricity bill. If you have a trash can in your office, a portion of your trash bill. You cannot take your water bill because you would have to have a separate bathroom for customers. So water's a little tricky. Phone bill, only if you have a separate phone number landline that you use for your business. I'm willing to bet 99.9% of you do not have a separate landline. I mean, I'm willing to bet probably 75% of you don't even have a landline as it is, because I don't have a landline. So I don't even, but if you did have a separate landline phone number, you could deduct a landline as part of your home office. Property taxes as well, as part of your mortgage, you get to deduct all that. There are two ways to take the home office deduction. You take your office. If your office is a 10 by 10 room and your whole house is 1,000 square feet, your office is 10% of your house. So you would accumulate all those expenses, multiply, your tax software will do this for you. You multiply your tax, all of your expenses times 10%, and that's what your home office deduction is. There's a simplified method where you can take $5 per square foot. So in that same example, your office is a 10 by 10 square. It's a 100 square feet. You could take $5 per square foot and get $500. Take the approach that's most advantageous to you. If the square foot method and applying the percentage to all of your expenses is better, take that one. If all of your expenses are not that great, take the $5 per square foot and take whichever is most advantageous to you. So the home office deduction is only available for self-employed individuals that file on that Schedule C that's attached to your tax return. It is a great tax deduction that you get to take advantage of by owning your business and working out of your home. So I really wanted to speak to that because that's something that comes up a lot. To do that, just keep track of what your expenses are. You can do it at the end of the year. You just go through it. So, some things are the same, like your home internet might be the same every month. It might be $60 and that's it. Okay, speaking to the question about the whole room. Okay, so the IRS's definition of a home office is that it has to be used exclusively for business. That being said, if you were to ever get audited, move everything that's not businesses out of the room, and there your office is exclusive. But if you use a spare bedroom or if you use a corner, just to estimate like the corner of your dining room, estimate the best you can, and then just I have a bookshelf that doesn't necessarily have just business expenses, but for the most part, this room is used. Nobody really comes in here unless they're working. But if I would move anything like the bookshelf out that's not business only, and that's how. So it has to be used exclusively for business. Yes, yeah. I had to condense it so the corner room is the measured space. So do the best you can to measure what your space is, even if it's stationed at your dining room table, and this is the best estimate that you could do. Take advantage of it, and then if you were to get audited, just come set it up so that somebody would come look at it and be like, oh yes, that is your business, that's your office. So that's my advice on the home office deduction. Okay, so home office, cell phone, Amazon books, those are like the biggest ones that I see people miss. Let's see, because obviously the goal is always to take as many business deductions as you can, to minimize taxes, but do it legit. One thing that I do get questions on too. So we all would like to do photo shoots for branded photos, right? When we put things out there. So when it comes to branded photos and photo shoots and things that you do for that, if you get your hair and makeup done right before the shoot, that's deductible. Clothes that you buy for the shoot, unfortunately, are generally not deductible unless they have your logo on them. Clothes that you buy are not deductible, which is a bummer because sometimes you're like, well, it's my brand colors. I really like this shirt. It's really cute. It would be perfect. Unfortunately, the IRS has come back and said, usually that's not deductible. But if you go get your hair blown out, you get your makeup done, lashes, all, and then like on Tuesday, and then Tuesday afternoon, you go and do a photo shoot with all that, hands down, that is a business expense. So, time your hair appointments like right before a photo shoot so that you can take advantage of it. So don't be afraid to take things that you would pay for otherwise and make them a business expense by doing business things around the activity. Travel. I know we're not really traveling right now. Nobody's traveling, but business travel can be deductible. If you travel and you're going on vacation with your family and you're going to go away for a long weekend, and the goal is really to be with your family and things like that. But say you have a launch coming up and you really got to, if you work 50% of the time and you can prove that you worked 50% of the time, then if you take an airplane, your airfare is deductible. There's a way to take some of those business expenses. I know the goal is probably to be able to spend more time with your family, but if you end up working, make sure you take credit for that travel. That can totally be a business expense. If you travel for a meeting, okay, and you're going out there and say you have a meeting on Friday and a meeting, or say you're traveling for a meeting. Let me say this. Schedule your meetings, if you have 2 meetings, on a Friday and a Monday, and you can take the whole weekend as a business trip. Okay. So if you're going someplace it's far away, say I live in Pennsylvania, say I'm going to go to San Diego, I'm going to schedule a meeting on Friday and I'm going to schedule a meeting on Sunday or Monday. And then the whole weekend, even though it's not business related, you can explore, but you're there because your business meetings are Friday and Monday. So, oh yes, pay your kids for services. You can absolutely pay your kids for services. You can pay your kids up to, I believe it's $12,000 tax-free for them. And you get a business deduction for doing stuff for you. If you have teenagers, even if you have little kids, they can help. I mean, you'd be surprised at what they can do. If you have paperwork, they can file paperwork. If you have teenagers that are on social and you want them to pull a report or find followers or things like that, like teenagers are great for social. I have 2 teenagers. I could give them a million things to do on social and they would have it done in like nothing. Or Pinterest. Teach them how to use Pinterest. They can pin, they can repin, they can do research for you. You can absolutely pay your kids $12,000 a year. It's a business expense to you and it's tax-free income to them. And if you say, okay, here's your $12,000 a year, you have to put half of that in savings and half of it, like you get, and then it betters them as well too. Like they don't just get $12,000 a year that they can go blow, but they can save it and things like that. So you are still gifting. It's like an allowance, but you get them to help you with your business. Yes, stamping envelopes, inventory, all of that. Social media, teenagers is great. Up to, I don't know whether it's up to 18 or if it's just anyone that's a qualifying dependent. It may be anyone that is a qualifying dependent, but I can verify that and let you know if it's up to that. You do not have to 1099 them if they are your child. So they are exempt from that. So that's nice. But 1099s, that does speak to something else. So if you, it's March now, but hopefully 1099s, you either received some or you paid them. 1099s are something that you get from people that you will get a 1099 if someone paid you $600 or more for your services. If they paid you via PayPal, Stripe, credit card, they do not have to send you a 1099. If they paid you via cash or check, they should send you a 1099. The 1099, the onus is on the sender, not the recipient. If you didn't get 1099s, you are not penalized for that. If you paid someone $600 or more for services, mostly services, because there's goods, but that's a reselling thing, but mostly services, and that includes lawyers, that includes accountants, that includes coaches, that includes contractors, like if you're VA. If you paid someone $600 or more for services and you paid them via cash, check, or ACH, you have to send them a 1099. If you paid them via PayPal, Stripe, credit card, you do not have to send a 1099. Okay, so that's the same thing. only if you pay via cash, check, or ACH. If you pay them the other ways, PayPal sends 1099s to people that use their services to collect and receive money. So 1099s are a hot button item. The onus is on you to send them for those that you are responsible for sending them to. Last year for training. Today, yes, you can absolutely still deduct the tax, the training, the money that you spent on training, even if you did not get your tax ID until this January. So when there's a couple of different ways you can operate your business. You can operate your business as I'm going to use quotes, but as a business where you have a tax ID, you have LLC, organizational documents. That's one way. If you are just operating your business, just you, and you're still a business. It's called a sole proprietorship. You don't have to have a tax ID. Your tax ID is essentially your social security number, because the IRS sees you and your business all as the same. Confession, I've been doing my business for 7 years, and not until last July did I organize my business. I was just operating as a sole proprietor. So you don't have to form the LLC and get the EIN number. But even if you operated as a sole proprietor prior to this, everything is still deductible. It is all still business expenses. You still have a business, even if you don't organize an LLC, get the EIN number and things like that. Yes, if you have yes, you still do file with your husband. So you'll file your joint return like you always do. And then a new schedule this year will be the Schedule C, where you'll put in the name of your business. It'll have how much your income was. You kind of list out your expenses, your home office deduction. You'll still file together. And then when you, so as a self-employed business owner, when you have a W-2 job, you pay payroll taxes. Your employer takes out your payroll taxes. They put your money into the pot for Social Security, things like that. When you are self-employed now, you have to pay your own payroll taxes. So you have to contribute to Social Security, Medicare, and the federal income tax. But there's no way to do that because you're not getting a paycheck. So when you do your tax return, you'll put in all your income taxes, your income expenses, and then it will generate what your self-employment taxes are. So it's your portion as an individual of Social Security and Medicare, and then your income. That will flow through to your page 1 of your 1040, your regular tax return. If your business is a side business and you still have a W-2 job, or if you have a husband or wife who has a W-2 job, the IRS says the W-2 workers put into the pot, and then you put into the pot. They don't care how your money gets into the pot as long as it gets into the pot. So if you have a W-2 job, you can over withhold from that job, or if you can have your husband over withhold and put into the pot, as long as at the end of the year you either put into the pot from a W-2, from estimates, or what you're going to pay, your pot is full. So they don't care where the money comes from, whether it comes from you, it comes from your husband, whomever, and how it gets there. They just want it in the pot. They just want their fair share. So it can be your W-2, it can be your husband's W-2, it can be whatever. If your business last year had a loss, take the loss. It will offset your taxable income. So if your husband's income was $100,000, you just started your business, maybe you lost $5,000 because you spent more than you made. Take it, because it takes your taxable income down. You get a deduction of $5,000. Yes. So take the loss, take the expenses, take it, because you get to reduce your taxable income by the money. If your business is consistently showing a loss, which hopefully you're not there, if it's like a loss for 3 years in a row now, the IRS might come back and consider it a hobby, and then you don't get deducted. But if you can show that you are generally trying to make money with your business, then it will be a business. But if you lost money, it's the first year you were in business, or maybe even the second year, and you're like, okay, this is the year I'm investing in a big ticket coach, and I just don't take the loss, because it will offset the rest of your income that you have, whether it's from W-2, whether it's rentals, whether it's capital gains, all of that. So are you penalized for not paying quarterly taxes as an LLC? That depends. So the IRS, if your tax bill at the end of the year is $1,000 or more, they would like you to pay estimated taxes. If this is the first year you're in business, the IRS doesn't know you're in business, so you won't get penalized this year because they have nothing to base it off of. They don't know that you did. They don't know that you started a business. But if you see that you are going to owe $1,000 or more, they would like you to pay estimated taxes. The penalty, you are not dramatically penalized. Like, it's not like $1,000 a month. They just calculate interest and penalties on what you owe. If your tax bill is $1,000, it might be $25 in penalties at the end of the year. But if your tax bill is going to be $10,000, $20,000, $30,000, I would definitely pay estimated taxes. If you can afford to do it, I would put a little into the pot on a quarterly basis. Even if it's not a lot, even if you're like, I just don't know, put $100 in. If you can, because that way when it comes to the end of the year, it shouldn't be a surprise. And some of the benefits of working with someone or keeping track on your finances is so that come this time next year, it's not a surprise. You know, you have a pretty good idea all through the year of exactly what your bill should be. Some things will change, like the home office and things, like some of those are subject. But if you track your income and expenses at least on a quarterly basis and just kind of put aside that money for taxes, you know you'll have it, and it's a good practice to get into so that you don't spend it or reinvest it. Unless, if you can't afford to, then keep your money, because if you need it to pay your bills, by all means keep your money to pay your bills. But if you can put in just $100 a quarter, even if it's the minimum, do that. When you do your taxes, for example, when you do your taxes this year, if you are going to owe, your tax software, either your person who does your taxes or your tax software may generate estimated payments for you. You can use those, or you can calculate it on a quarterly basis on your own. So if you expect your income and expenses to be about the same year over year, it's going to be like, okay, it's going to be about the same. Use your estimates and you will create no penalties. If you experience significant growth, I would recalculate your estimates on your own or work with your tax preparer to have a consult to say, hey, I had a really big first quarter or big first 6 months. I think I need to adjust my income taxes, and then recalculate your estimates and do them again. So you are not really penalized. It's like a small penalty. It's not like $1,000 a month for every missed tax payment. So it's something to be aware of, that you will get to the point where once you start to make more money, the IRS will expect to see more deposits. Let's see. Should we set aside a certain amount % every time money comes in for taxes? If so, what would you recommend? This kind of follows with the profit first methodology and just a general. I tell people to set aside 15%. I say 15% of it. Some people say 15% of gross. Some people say 15% of net. I say 15% of gross because I'm personally conservative. I would rather have too much set aside than not enough. I don't want to be like, because unfortunately the IRS is not forgiving. You have to work out a payment plan. Like other things, you might be able to be like, okay, well, this month I'm not going to invest in the big ticket coach, things like that. I would rather you have too much and be like, okay, great, I have extra money. What can I reinvest in? Versus being like, oh crap, I have to come up with an extra $400 that I didn't have budgeted for taxes. So I say 15% of gross put aside. You can do it on a month-to-month basis. You can do it on a quarterly basis, especially if your income is cyclical and like 1 month, if you're launching 1 month, you might have a lot of income. The next month, you might not have a lot, maybe the next 2 months. So you're going to need some of that income to pay your bills. So if you're doing like a strategy like that, where you have a launch and it's going to be your income for the next 6 months, take that 15% right off the top and put it to taxes. If your income is steady every month, then just take 15% right off the top. And this is where the profit first methodology comes in, where they tell you to transfer it to a separate account. So that way you don't ever get to spend it, because it's not like in your head, you're like, oh, I have to remember that I have 15%. Don't take it right out. And that way you don't ever have to, you can't touch it. It's for taxes, and it is what it is. It's there for you. I hope that answered the question. Does an LLC on a Schedule C use a Schedule C as well? It depends. I know people hate that answer. It depends. If the LLC has one owner, like it's just you, you're the only one that organized the business on your state paperwork, you were the only one that signed it, then yes, you will file a Schedule C. If by chance you and say a friend started a business and you formed the LLC, because an LLC is a state designation. It's nothing to do with the IRS. It is how your company is formed at the state in which you live in. So if you and a friend, or even if you and your husband, if you added your husband to your state LLC paperwork, if it's your husband, some states will say that no, it's just you guys are together, you file a Schedule C. Some states, so community property states, if it's you and your husband on the LLC, you file Schedule C. Other states, like the state that I live in, Pennsylvania, you and your husband formed the LLC together, because say you wanted his name on it too. Now unfortunately you formed a partnership and you have to file a Form 1065, which is completely separate from your business. And that's due March 15th. So if you did file that and you didn't know that, I suggest you talk to somebody. I'd be more than happy to answer questions. But if you live in a non-community property state, and hopefully you know if you live in a community property state, and you put your husband's name on your LLC paperwork, you do not file a Schedule C. You have to file a separate return. It's a 1065. It lives independently of you. Then you, as the business owner, get a K1 for your portion of the business, and that's what you report on your income taxes. The other caveat with the LLC. So when you have an LLC, you can be taxed as the Schedule C LLC, making no elections. If you just form your LLC with the state, everything's fine. You are taxed as a sole proprietorship. It goes on your personal income taxes, the Schedule C. When your business gets to a point where you are netting, after all expenses are paid, between $40,000 and $50,000 a year, there are tax advantages to having your LLC treated as an S corp for taxation. So when your business is netting $40,000 to $50,000 a year, start talking to somebody. So what that means is then your LLC goes from being attached to you to being its own independent entity. When it's independent, then you as the owner must go on payroll, and then you will get a W-2. So then now instead of paying your taxes with your self-employment on the Schedule C, now you're going to get a paycheck. You're going to be a W-2 employee, just as if you went to work at Walmart. You're going to pay your payroll taxes that way. There are tax savings to doing it that way, but it only makes financial sense when you get to a point where your net income is higher. So the question with does it use the schedule? Yes, for the most part, but there are the certain different taxes. Okay, what do you suggest if your estimated tax amount due is higher than expected? Should I just send in what I can and the rest? Yes, you can. There are payment plans available. The IRS will work with you to make a payment plan. It's something I'm not 100% familiar with the process, but I know that it is an option. They send in what you can, and then there are forms that you can fill out to help set up a payment plan so that you can pay if it's every quarter, every month, things like that. So yes, they will work with you on that. They will always work with you to get their money. So, and as long as you're proactive about it and not just not paying, they will work with you. What happened? So yes, how about an LLC with the S corp? The LLC with the S corp that's when I'm assuming that the question is, that's when your LLC is elected to be filed as an S corp. Your business then files an 1120S, which is also due 3/15. So if you made the S corp election, so that's something you would have had to make. You would have had to file either Form 2553, electing to be treated as an S corp status. That tax return is due 3/15. So you have 10 days. If hopefully you knew that, and you then the S corp business files the 1120S. You as the owner get a K1 for your business, and you also got a W-2. So you get a W-2 for your salary, and then you get a K1 for what's left in the business after you took your salary. It's a little more of an advanced explanation, but you still might have to pay self-employment taxes, but you pay a lot less than if you kept everything as an LLC without the S Corp election. So I hope I answered that question with the LLC and the S Corp. If there's follow-ups, just let me know. Let's see. I hope there wasn't any more questions in the chat. Purchasing. Okay, so Marla said purchasing makeup and makeup training specifically for business videos use. What's the nitty gritty for that? Separate makeup for daily uses, though, is what I'm thinking. So it depends. I think it depends on what your business is. Is your business like a makeup artist where you would be using it, or is it for like, is it part of what you do, or is it just to make yourself look better in the videos? Let's see.
Hey there, I can speak to that. Sorry, I have sick kids in the bathtub behind me, so pardon the noise.
No worries, we've all been there.
Yeah. Okay, so I do all of my services via video, and then I love using video for promotion, that kind of thing, which is why I bought this makeup from this person who's a professional makeup artist who does training on like, this is how to create a corporate look for when you're doing video live and that kind of thing. So that's why I was wondering, is that something that I can, like, she markets it and says, oh yeah, you can absolutely write this off, but obviously it's not a branded thing. But it is a tool that I specifically use when I am creating marketing material or when I am preparing in serving my clientele.
I would say, this one's different.
Right. That's why I said it's kind of a nitty gritty. Yeah. My gut was like, oh, I should, just like a home office, like then I should have separate makeup for daily use.
Yeah.
Is that?
I would. I don't know that I've ever seen anything like this. And I don't know if the IRS would take the position that it's like the clothes where you could use it, but you don't. I'm not sure how that would be viewed. My gut is stick if you feel confident and justified that that you could go to bed at night saying, yes, this is a legit, like this is a business expense. I would not have bought it if it wasn't for my business. I would not be using it. Then I say stick to your gut and take it. If you feel wishy-washy at all about it, I would err on the side of conservatism and don't take it. But if you can stand your ground and say, you know what, one, I wouldn't have purchased it if it wasn't for this business. Two, I keep it separate. And because I see some similarities to food bloggers who do the same thing. Like food bloggers and things, they buy items for for cooking shows or demos and things like that. Well, those might still like be in their pantry, but they're not using them for their everyday. They're used exclusively for their business. So, I can draw similarities to that same situation where I could be like, okay, well, yeah, you're using it only for business. You're not using it every day. You're using it for videos that you're promoting and advertising and marketing materials and things like that. So, I mean, I would say if you feel firm, go with it. If you feel wishy-washy and it gives you a little unease, then don't, and trust your gut. So I hope that helps, Marla.
Yes, that helps. Thank you.
Okay. Okay. And then your other question was, can I write off pro bono services? Do I have to have I've invoiced with the service cost and then a discount shown, or can I just write the amount based on my records? Okay, pro bono services are tricky. So if your business is a Schedule C business, like we've talked about, and you make charitable donations from your business, pro bono services, things like that, those charitable donations, unfortunately, are not business expenses. They flow through to your they're personal expenses. So you only get to take them on your personal tax return, no different than any other charitable donations that you would have done. This year, the IRS was very generous, and they gave, if you make donations, if you tithe, if you donate, provide services, everybody that donates, if you did $300 or more, you get a above the line $300 donation for $300 deduction for donations. Okay. So if you give $1,000 to your, I'm going to use $1,000 to your church right now, this year, they say you absolutely get $300 right off the top. You get to take that. The rule with charitable donations is they have to exceed a certain percentage of your AGI, your adjusted gross income, in order for you to get any benefit from it. So unless you donate a lot, most people, unfortunately, don't get the benefit of it. It's a very sad thing. But I would say, myself included, 99.9% of us do it out of the goodness of our heart, not for the tax deduction. So if you've donated services and things like that, it's the goodness of your heart. You're doing it more for the goodness of your heart than you are for the business expense, because unfortunately you probably won't get to take advantage of it. Because as a Schedule C business owner, those flow through to your personal, and you are limited by they have to exceed a certain amount in order for you to be able to take them. If your business is one of the standalone entities that we talked about, like the S Corps or the C Corps, some of them you can donate, or sometimes they will come through as sometimes they are business deductions, like charitable donations. Other times they will flow through to your K1, and then they flow through to your personal return. For pro bono services, if my gut says to see, I'd hate for you to record the income and not get the subsequent deduction for it, because that's not fair to you. But I don't want to give you shady tax advice, because that's not what I'm about. So, if you record, say you offered $1,000 worth of services and you're going to take a charitable deduction for $1,000. Unfortunately, if your income if you don't have enough deductions, that $1,000 is wasted. So you have $1,000 of income, but you don't get the corresponding deduction for it. So while we do it out of the goodness of our heart, I also want it to make financial sense for you as well, so that you don't give away so much of your services and not be able to get some type of benefit from it.
Okay, so can I ask a follow-up to that?
Sure, absolutely.
Okay, so then I do offer this, and very, very rarely out of the goodness of my heart, and you're right, and I'm not doing it for that sake.
Yeah.
But also trying to be a wise business owner and a wise steward of my time and my resources. What is an appropriate percentage? So you're saying, like, you don't want us to not be able to take that deduction.
Yeah.
So what does it look like if I'm making $1,000 this month?
Mm-hmm.
How much of that would I then possibly be able to deduct? Say, okay, I can give away $100 worth of services, or whatever. Is there a number? Is there a way to calculate that? Just a moment, baby.
It's going to be, so if you make 1,000 and you want to not give away, but if you want to do pro bono work, I don't know if there's a really good way to calculate it, because it's going to, like I said, it's going to flow through to your personal, especially if your business is a Schedule C business. So you would potentially lose that, unless the workaround is if you can classify any of those pro bono services as advertising. So this is how charitable deductions become non-charitable deductions. If you feel you got any benefit from them, like when we give to our church, it's not advertising. Like that's not advertising. But when you give to maybe a community organization or to an individual, if you feel that you are getting any benefit from those donations, like your name goes on something, there is a position to be taken where you can classify those monies out as advertising and not donations. So if you feel that you are getting like maybe you're just giving them a discount, then I would do income less discount, and then you get the benefit from it. So it would be more of it wouldn't be a charitable deduction, it would be a discount. So when you invoice, generally when you look at your profit and loss, you have income, cost of goods sold, and then that gives you your gross profit, and then you have all of your expenses. For some of us, myself included, as an online business owner, we really don't have a lot of cost of goods sold because we are our service. We're not making something, so we're not buying something and putting it in there. But one of the costs of goods sold or an offset of income is a discount. So it'd be no different than you saying, okay, recurring clients get a 20% discount when they book, when they prepay in advance. We all get it. We have Canva. You get a discount when you buy Canva ahead of time, right? Like you don't pay $12.99 a month, or it's like the $120 or $12.99 a month. You get a discount when you pay ahead of time. So you can discount your services, and that would be a way of being able to do pro bono and still not having to miss out on the deduction. So you have your income of $1,000. Let's say income of $10,000. It's 10 different people, one of which is going to be a pro bono. So you have income of 10 minus a discount of 1. Say one person got $1,000 worth of services for free. Then your net income would be 9, because you're discounting that $10,000, one person's $1,000 service to offset. Does that make sense?
Yes, that's very
Okay.
helpful.
Okay.
And that actually, because that's why I wanted to make sure I'm not giving away too much.
Yeah.
That I tend to be on the side of giving away too much. So
yeah. I would do it as discounts and then track your discounts and be like, okay, how much am I really giving away? And that way you can see it as a separate line. And that way you still get to take advantage of it, like of the business expense reality of it, but you still can also track it and be like, okay, I gave away $1,000 on 10,000, or I gave away, 7,000 on 10,000, and you can see it better that way.
Awesome. Thank you so much.
You're welcome, Marla. Okay. I think I got caught up on all the chat questions. So are there any others? I'm here for you. Anything even very specific to what your business is, or things that I maybe didn't talk about that you were hoping that, because to me, it's all like, I have all this, but I want to make sure that I get your questions answered, because I know that you all have specific questions that might relate to your specific situations. So.
This has been incredible. I mean, I thought I knew a lot of stuff about taxes and write-offs and all this, but you have really, I've been taking notes like crazy, and just thank you.
No problem.
Yeah.
No problem. But yeah, that small business checklist cheat sheet, it has a lot of different examples of things that you might not have thought of that were business expenses, but definitely are. Mm-hmm. I could go through each category, but I won't. I'll save you the time. But look through that, and you might be surprised at some things that you didn't think that you spent money on that you legit get to claim as business expenses. So
yes. Amen.
You're welcome, Heather.
So yeah, if you have questions, definitely come on live. Otherwise, Karen, how can they find out more about you, what you do? Just stay in touch with all of your amazing goodness.
You can follow me on Instagram. That's where I spend most of my time. I'm also on Facebook too. I think it's _ Karen Kirkpatrick is my Instagram handle. It's where I spend most of my time. But you can also, if you're interested in, so if you need ways to work with people. So the ways people work with me, I have fully outsourced accounting, which some people don't need. They've got their bookkeeping good. I have tax return preparation, and I have business intensives. So if somebody wants, it's in 90 minutes, we can go through it. Nothing is off the table. Fair game. Anything and everything that you want, you can have. You want help setting up your systems, you want help talking through your tax, anything. I offer those to business owners that might not need fully outsourced accounting, but just want a CPA to answer questions and talk through their business with them. And it can be things like setting up your even just setting up your LLC. When do I need to do it? Talking through the S Corp, stuff like that. So those are 3 different ways to work with me. You can check out my website, KarenKirkpatrick.net, for more information. Or if you want to book a discovery call, just chat, things like that. I'm an open book. I will answer any and all questions. If you have a question, you can shoot me a message on Instagram. If you come up with something after this call, you're like, oh shoot, I forgot to ask Karen this. Shoot me a message. I will always answer questions. And if I see a bunch of people have the same questions, I will let Kari know, and we can, put something, post it so they'd be like, hey, this question came up a lot. Here's it because I know if one person has it, somebody else probably has it too. So,
Yep.
Oh, good. I'm glad you guys found the checklist helpful. So, good.
Wow.
Good.
Oh my gosh. Thank you so much. Super helpful. I know we made some husbands very happy, and
good. I'm glad.
ourselves too. Like it's a great thing to be able to invest in what we need for our business and know that, it can be an invest in a write-off or deduction.
Yes. It's all like, if you've watched Schitt's Creek and you've seen the write-off scene, it's floating around on Instagram. It's everywhere. It's hilarious. And if you haven't seen it, you should Google Schitt's Creek write-off and you will laugh. It's so funny. I mean, it might just be funny for me because I'm an accountant, but for everybody, like, I hope other people find it as funny as I do because it's hilarious. But yes, so, and always, one other thing I tell people too is, especially new business owners, that when you spend money in your business, some people struggle to spend money because they're like, oh, I don't want to spend money. Don't look at it as spending money. Look at it as reinvesting. You're reinvesting into your business, whether it's you as a business owner, whether it's reinvesting in your clients, or whether it's, growing your business. It's not spending money, it's reinvesting. It's all about shifting your mindset to know that you're doing this, you have a purpose for your business and you have a purpose for your life. And, spending money, while it may seem hard, if it's the right decision, you'll feel it in your heart and you'll know that you're reinvesting back into your business is the right thing for you. So.
Right. And you have to think about the ROI too.
Yes, absolutely. Don't just spend for the sake of not paying taxes. That is not fiscally responsible. That is absolutely not fiscally responsible. Don't just go to get to December and be like, oh crap, I'm going to owe $10,000. What can I go buy? No. If you were already thinking about the purchase to begin with, maybe that's the time to purchase it. But if you weren't thinking about it, don't be frivolous with your money. That's not the point, So yes. Well, okay, let's talk about real quick. So no investing in steak dinners. Let's talk about business meals. Forgot to mention this one. We're not going out a lot right now, but if you go out to dinner, your husband, wife, boyfriend, girlfriend, and you talk business, put that meal on your business credit card, okay? Put it on your business credit card. Right now in 2020, 2021, and maybe 2022, all business meals will be 100% deductible. Usually they're only 50%, but in 2021, they are 100% deductible. So keep your receipt, write who you went with, and what you talked about on your receipt. Dinner with Charlie, we talked about business and my goals for this month. Boom, it's a business expense. Yes, even local. Yeah, they should be, yes. Yes, now you may tell him it is allowed because you get a business deduction, So, I know a lot of us aren't, it's hard to go out right now with everything that's going on. But when we get to the point where hopefully we're, out and about more, those meals, if you talk business at your dinner, it is a business expense. I forgot all about that one. How did I forget about that? I guess because I haven't gone out to eat in so long that you forget about it. But yes. Next.
Ooh, I am so glad you mentioned that, Cindy.
Yes.
This was good. 100%. I had no idea. I thought it was still, 50.
It was part of that last round of stimulus monies that it is 100% to try to stimulate the economy and help support small and local. So go support your small and local businesses. Yes.
It's our duty, right?
That's right. Let's others out. Yes.
Okay. Cindy says I'm stimulated. You guys are awesome. Oh my gosh, that's super fun. Okay, date night / business meeting tonight.
That's right. There you go.
Thank you. Wow, I am so stunned. I was seriously thinking I was being a smarty pants there, and
I'm glad you said something.
I have no idea.
All about
glad
that.
they did something for me.
Yes, you did.
I do have a friend who has been in a situation where it's really sticky, and he has a business where he does a like flooring. It's really amazing. Like I don't know how to describe it, for like garages and basements.
Mhm.
That, I mean, it looks kind of, anyway, it's beautiful, beautiful. Well, he had a situation where he was getting ready to get married, and they bought a house, and then everything went south, and he had done a bunch of work on the house. But right now they've had to go through all the stuff just to get, a decision made on how to part ways with the house and the investment. But some of it, he did not get the money back that he invested into the house, because they basically did a split of, okay, the whatever is owed on the mortgage, and then 50-50. But that doesn't even really touch the amount of money that he put into like his staff doing work on the downstairs, and all that. So how would he prepare any of those kind of things? Is it a loss? What is your professional opinion?
It would probably be a loss. Like you would, I mean, there's a couple different things that go into it. Like if the wages that he paid to the employees and things like that, it would probably, there's some circumstances, but you probably do get to take credit for the loss. But I don't know, depending on how the entity's, like there's a lot of factors that play into that, like how the entity's structured and the actual calculation of the loss and the basis in, like, so you have to calculate the basis in the property, and then the selling price and the loss that you did, and if you can support the amount for the work that was put in, and how that raised the basis of the investment in the basis of the property. Because you do get to take losses when you sell something like that, even if it's not a good situation. Like it was a forced sale versus a, for fun sale, like where you intended to. But they'd have to be able to substantiate the basis investments and then the expenses that would increase that, so that they could take the loss on the sale. So I hope that helps.
So see an accountant.
Yeah,
Talk to your
that would
accountant.
definitely be I would recommend talking to somebody about that, because that's probably a little more complex than TurboTax. So I would definitely recommend talking to somebody about that situation, because there probably is more to it, and you want to make sure you handle it the right way, so that you don't get dinged and you get to take advantage of whatever is available to you.
Yeah, because some of it's his personal and some of it would be his business. It was really put together in that situation, and I was like, wow, that is messy. Those kind of things. It makes me happy that I can just go eat steak in Mexican.
Yes.
Mine is so clear. Thank you.
You're welcome.
All right. Any last questions? Oh yeah, Heather.
Unmute. There we go. Okay. So if I'm alone and I'm discussing business with myself, can I deduct a meal? Or is that a psychological issue that's different?
Generally, the IRS says no.
Okay.
Like if you go to a coffee shop and work all day, they generally say no, you can't.
Because you were going to eat anyway.
Yes. They don't look at that as they generally don't allow personal meals. If you're traveling, I forgot to mention another one.
Yeah.
I think of all these things. If you're traveling, you can deduct your meals. So here's a tip for all you moms. Okay. Maybe you need a weekend where you just need 24 hours of uninterrupted time.
Yeah.
Okay? Go book a hotel in the next town over
Done
and
it.
work. And that's a business expense.
I've done that.
Yes, that is a business expense. Your meals while you're there are a business expense, because you're obviously not at home. Like you can't just eat there. So those meals are deductible.
What if I take my kids out who work for my business, who, with my $12,000, what if I take them out?
Meals for employees are deductible. Yes, meals for employees are deductible. It's no different than like a holiday party for companies, the same idea. It's like an employee appreciation type thing.
Okay.
Yes.
So if my kids are doing work for me sometime, I
Mhm.
can take them to a meal some other time and feed them.
Yep.
Life is
As long
better
as,
than
talk business, talk business and write on your receipt, like,
of course.
hey guys,
Okay.
Here's, how do you think your project went when you worked for me 3 months ago? Oh, okay, that's great.
Okay.
Like, but yeah.
All right. Thank you.
Yes. What if she shares her business card with someone at the restaurant? That one's going to be trickier. That's a maybe. It would depend on, because that could kind of be like advertising and networking. That one would be a little trickier. I don't know on that one. People while eating or coffee. So if you minister to people while eating or at coffee, so it's part of like a group. Like if your group is there, but everybody buys their own drinks and you are ministering to people there. If it's so if it's expected that you purchase, let me try to think how to word this best. So if you're ministering to people while eating or at coffee, I would say take it, write on the receipt what it was, the events, what it was, when it was, and what it was. So the risk is, when I say like, is it allowed or not allowed? If you take something and by chance you get it audited and the IRS says, no, that's not a business expense. What happens is they say, okay, it's disallowed. So then they just recalculate your taxable income and you could owe a penalty. Like if it's an $8 coffee, it's not going to drastically change things. If it's like a $10,000, down payment on a car, that's going to change things. If like, same back to Marla's situation, if you feel at all wishy-washy about it and you just don't feel comfortable, don't do it. Because it's not worth losing sleep over, and it's not worth stressing yourself out over something that you're like, I'm not sure. My goal is to give you things that I know for sure are legit. Like, so the IRS code is super long. There is more words in the IRS code about what's not taxable, like all the deductions you get to take, than what actually is. Like they just kind of tell you whatever comes in is taxable. Well, here's the huge laundry list of things that aren't taxed, like that you don't have to pay taxes on. So while they are generally pretty, like, there's a lot that you can take on. If it makes you wishy-washy at all or makes you uncomfortable at all, err on the side of conservatism and don't take it, because the last thing you want to do is be stressing over or be like, oh my gosh, like what if they pull me and I can't, like, no, like stick with the ones that you know are legit and that you've been like, okay, I know I can stake my claim and I will fight for this one. But if you're like, well, I don't know, don't do it. So mileage when driving to meet a client absolutely is deductible. Absolutely, 100%. You get on that Schedule C, you get to take your mileage and keep a mileage log. It can be real. And if you go to the same places every week, keep a mileage log. What I tell people to do, it's a little late now, but you could still backtrack it. Put a calendar reminder on January 1st, go out and take a picture of your odometer, because you're going to need to know your starting mileage at the beginning of the year and your starting mileage at the end of the year. Take a picture, and then when you have to go do your taxes, you scroll up and be like, okay, on 1/1/2020 it was this, on 12/31/2020 it was that, and then you have your mileage log for wherever you went, and the difference is your personal. So you have your beginning odometer reading, your ending odometer reading, your mileage log, the rest is personal. End of discussion. So put that calendar. You could still go back and do it now. Take a picture at 3/1, because I mean, myself included, I haven't gone that many places. I could probably, in the 2 months that has been January, I could probably backtrack and tell you what my miles were on January 1st, because we really just haven't gone that many places. But you can at least get 9 months and then take the picture, know your odometer reading, back into your track your mileage for when you go to clients. Tolls, if you have to take a turnpike or go over a bridge, those are deductible when you go to and from clients' houses. Parking, if you have to go someplace, like if you have a meeting and you have to pay for parking, that's deductible as well. things like that. So sometimes like Easy Pass, if you live in a state that has an Easy Pass, go back and look. If you did a lot of traveling, go back and look at your Easy Pass statement and take the credit, take this. So yes. Well, mileage to business dinner is a little trickier because I don't know if you can do that unless it's with a client. If you're meeting a client, then yes. But if it's just you and your husband, then no. But yes, if you are meeting a client for a business meal, that is the business deduction. Yes, take the mileage. You're very welcome, Jamie. I'm so glad. See, I get off on tangents. As something comes up, I think of another one, and then another one, and then another one.
Yeah, there's so much.
Hey,
so much we don't think about.
Karen, I get confused because, okay, once upon a time I used to do real estate and they were really picky about like how we could count mileage and stuff. So I kind of got like, oh, I don't even want to think about that anymore. So it was like hard for me to even take that. So anyway, long story short, now that I am writing, speaking, podcasting, that kind of a business again, what would the mileage look like? Like, I know that they were saying things like if you leave your house to get to wherever you're going, you can't take it, but you can do, you know what I'm saying with that?
Yeah, mileage for realtors is different because you can't, when you leave your house and go to your first showing, that mileage is not deductible, but from showing to showing to showing is fine. And when you come from your last showing home is not deductible. So that is weird.
Right.
This is different. When you leave to go to
post office
to mail something, that would be deductible because you are taking a trip outside for business. So that would be something that you would deduct for. But yes, the realtors do have different, and same with like house cleaners, where yes, your business is at home, but it's not really at home. Like I have a client who's a house cleaner, so her mileage from her house to her first appointment is not deductible, but from all the other appointments is. But then her mileage from her last appointment home is not deductible because while her office is at home, it's technically not, because your service is not done at home. Like you can't be a house cleaner in your own house. Like you have to leave your house to perform your services. So if your job, your business requires that you must leave your house to perform your business, the mileage from your house to your first appointment is not deductible, and from your last appointment home is not. But if your business does not require that you ever leave the house for your business, like you could, in theory, never leave your house, then that mileage is deductible. Does that make sense? Like if you travel, like you're traveling to speaking jobs, that is deductible because in theory, you could do that at home. Like you could be a virtual presenter, correct? Yes. But a house cleaner and a realtor, you cannot. Like you physically could not do that from your house. So you have to travel. Versus yours, you do travel, but that's part of your job. Like there's a slight delineation. It's kind of confusing, but there are certain categories where they are very particular about tracking mileage. Realtors are definitely one of them.
Oh, I know. It's really scary because I know we had a CPA come in and he spoke to us about, really being careful because his most audited people were realtors. Yeah. And so it kind of made me go, oh, but anyway, but that kind of moves me back to another category of what in the earth do I ever do out that would be personal? I mean, really, because I mean, if I'm riding with family to go to church, or I mean, I might occasionally go somewhere by myself, but that's very rare at this point, and that it's not business. So what do you do to just make sure that you do have some personal on your vehicle? Isn't that crazy? Because I really don't have
and I
life.
think right now and I think even now the environment's even more because, we're not going for the Target runs, like, whenever you want. We're doing a lot less. So any trips that people make might be just business because, maybe it's going to the grocery store, little things like that. But even then, groceries deliver now. So who needs to go to the grocery store? Like Walmart delivers, Target delivers, everybody delivers. So it's not like you have the fun to go, go to the store and just walk around and go to the mall, or, we're not traveling and things like that. So I think it's kind of tricky right now because people aren't going a lot of places. So anywhere you do go, it can't always be expected that you're going to have thousands of personal miles this year, when probably most people aren't going to have that many miles as it is, because they aren't really going as many places as they used to be. So
Right, right. Well, I'm just not. And I mean, pretty much like even today, I've been like, okay, I got to do this, 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 and this. And I'm making it all compact, but there's a lot. So all of that would count, in other words,
yes.
not personal. Okay, even if.
Well, it depends. So the mileage has to be for like business purposes. I think what I would do is I would err on the side of caution and keep a log. And then at the end of the year, if things just don't add, it's easier to keep a log and not include it than it is to try to go back and recreate the wheel and be like, okay, where did I go this day? Where did I go that way? If you're already in the habit of tracking it, then I would do track it. But if you're not in the habit, then the mileage is only like, it's like 50 cents a mile anyway. Like while I encourage you to take it, it's not going to be a make or break deduction on your tax return. But if it's something that you're already in the habit of tracking, I would say track it. And then when it comes time to actually do your taxes, if you prepare them or if you have somebody else prepare them, that's probably a conversation that you'll go through line by line, and it'll be more of a justification. Like, does this make sense? Are we going to draw more red flags by including all of this mileage? How comfortable do you feel? Like, again, is it wishy-washy? Can you support it? Can you stake your claim in the ground and say, yes, I stand by this deduction, I fully 100% support it? Or is it that wishy-washy, like, I don't know, am I reaching the straws here? Then go for it. But if you're already in the habit of tracking, I say track it. If you can't use it, you can't use it. Versus if I come to you and say, if I'm preparing your tax, I'll be like, hey, did you go anywhere? And you're like, well, let me look through my calendar and recreate the wheel here and try to come up with business mileage. If it's going to be so much of a stress, then I wouldn't worry so much about it. Okay, I hope that helps.
Okay, thank you. So sorry.
Okay, no, don't be sorry. Okay.
All right. Well, wow, that was jam-packed. Thank you again, Karen. Really can't thank you enough for your
You're welcome. I'm so glad.
And a wealth of information.
Oh, good.
Yeah, and kind of exciting. Like I said, this was going to be fun, but like now, like let's celebrate this knowledge and go out to eat and support those local people. Like,
support the local people. That's right. There's so many businesses that they just want to survive and thrive. So let's go back out and support them and get them back up on their feet too. So
yes, yep, totally. Okay, well, we look forward to being in touch with you. Thank you again, and super awesome information. And look at the deduction and reach out to her with any questions.
Yes, please. Thank you guys so much. It was very nice meeting all of you, and I hope you have a wonderful rest of your Thursday.
Thank you. See you guys later.